are watching Metropole Television. My name is Simba Elijah Charles Kiange. Thank you very much for choosing to begin your day with us here on a Business AM. Let's get into those results for Absa Group, because we do know they've actually given us their half-year results for the 6 months of 2021. Let's go back to where they were in 2020 for us to get proper talking points this morning. And if indeed we're going to have exactly where Absa are right now and at 2021, we have to go back and see exactly what their key performance indicators were for the financial year 2020. And we do know exactly what was happening entirely during that period. It was a coronavirus-ridden economy, and majority of the lenders in the economy did give us that sort of reflection in their results, which is exactly what we're talking about there. You can see exactly what they were when you're looking at that profit after tax. We do know they were around at 4 billion, and you can actually see that profit before tax for the financial year 2020. And what is key to note again is where they were in terms of their total interest income for the entire year of 2020. Now let's cross over and look at their profitability trend for Absa Group, and you can actually see there that their worst again was in 2020 as expected, because what was going on in 2020, as we do know across that board, is provisioning for loans and restructuring of the loans in the entire of the banking sector. It is 2021. 6 months down the line, 2021 was seen as a recovery year. Question that we're asking this morning: is there an indication that indeed 2021 is a recovery year for this sector? And joining us this morning, just to put into perspective the results for Absa Group in the first 6 months of this year, we're joined by the Chief Financial Officer, Absa Group, Yusuf Omani. Good morning, sir.
Good morning, Wasim.
Happy to have you around. Let me begin from this perspective. I mean, 2021 was deemed the recovery year for the economy, and then it makes sense for us to look at then how 2021, especially the first 6 months, is reflected in your performance as well. Let me get into that. Profit after tax for the first 6 months of 2021 has jumped to 5.6 billion from 0.6 billion. Mr. Mani, could you paint for us, give us a comment on what your key performance indicators are for your group in the first 6 months?
Thank you. We last year where COVID hit us, we didn't have experience on how to respond to it. And I recall very well last year, we gave a lot of support to customers with moratorium. We did about 30% of our lending book. And that was in 2020. Come 2021, the learnings are with us, and we are now pushing with momentum. We know the sectors that are growing. So if you look at our balance sheet, we were able to advance, lending to our customers, increasing that by 8% compared to what we had done in the previous year. And tied to that, the deposit momentum in the economy picking up. That helped us to grow it by about 6%. That is what informed the financials. You'll see that our revenue year on year, and this is not just the net interest income, which has a direct link to the loans and advances and deposits, but also when we look at the non-interest income component, which has also picked up by 6%. Lots of diversification that we have done, which then has resulted in that uptake of 6%. So that's in terms of the revenue. If we look at our cost, the COVID environment last year has given us a very good, base and learnings in terms of how we serve our customers. So we've seen a big jump of our customers using all alternate channels, digital channels, which means our costs in terms of staff cost to do with our distribution channels also down. Things like utility, that meant that our efficiency store come through the period coming down by 3%.
Yes.
That has helped our efficiency story. If you look at our cost income right now, it's actually at 45%. It's a good transformational journey that we've taken. The last number I'll speak to there is if you look at our impairment, last year impairment was quite high. And in there we took what you call forward-looking provisions in the difficult circumstances we're having as a result of COVID. And as I mentioned, the payment holidays that we had given our customer. If you look at these financials, impairment has basically now come down by about 64%, which then of course informs the profit that we've reported.
Pretty much. All right, now let's go back to that data again, your key performance indicators for the financial year 2020. And if you could look at that data that we're showing you this morning, which if you could actually put it up, yes, profit before tax for, let me just talk about profit after tax because that's what's key to look at this morning, was around 4.1 billion. But in the first 6 months of 2021, we do know that you've already eclipsed that. We are talking about 5.6 billion. From where you sit at this morning, is this a clear indication that indeed the talk about 2021 being the recovery year is indeed true? And do we expect these numbers to continue to grow for the following quarters of the year?
Yeah, thank you. I think stellar performance for the first half. We still have some, headwinds, coming our way. We know, for example, COVID, the third wave is going on. The level of vaccination is low in the country, although we've seen very good efforts coming from the government in terms of bringing all these vaccines.
Yes.
So those of us talk to them as headwinds, depending on what happens on that perspective. If we're able to bring that up, we continue opening our economy, further sectors that are still in time are still, in a recovery phase like the hospitality. If that can be addressed, we see the tourism, the hotels starting to do well, then to expect this kind of performance to continue in the second half.
Yes.
So those to me would be the key metrics that we need to look that supports the economy, then ultimately supports our customers who are actually the driver of this performance.
Fantastic. Let's move to the next area that is of key focus as well. I mean, we listened to your CEO during the release of those results, and his opening comments was like, indeed, we do project the GDP, yes, by various stakeholders to grow by around 4.31% this year. So which makes me wonder then, what specific sectors and industries is Absa Group really heavily hinged upon for us to say that should these sectors grow then, Mr. Yusuf, then we do expect that Absa earnings also continue to grow this year?
Yeah, so when we look at the areas that, have done although the bit on telecommunications, those areas, those sectors have done well. If you look at wholesale, retail, those ones are starting to recover. The businesses are opening up, and the economy is becoming vibrant in those areas. Areas, as mentioned, that we still see some challenges really is in terms of hospitality.
Yes,
I think that is big. And if we don't get that coming through, then you find that, the speed of recovery will be reduced, if these ones don't go. With this one is, for example, the tourism sector, it's starting to pick.
yes.
In Europe, quite a big chunk of the population has been vaccinated all the way to, to the US, and this group are starting to travel. But then in the country, if we are not reaching at those same levels, we are not getting these variant, challenges that are coming through, then that could be a dent on the economy recovery.
Fantastic. Let's also move to the next area as well. I mean, MSME lending is an area that has not ticked so much in the economy, because we can actually also see that in the first 6 months of 2021, it stood at 7.7%, meaning the double-digit figures are still elusive in the economy, and COVID-19 really did not do much good, especially when it came to how majority of the lenders in the economy viewed this specific sector in terms of a volatility. Talk to me. How are you approaching this specific sector? Because we do know, once we knew Absa, the brand, you've been associated so much to lending to this specific sector.
Yeah, a very good question, Simba. Thanks for that. I think when I recall last year, the business that really raised their hand and said we needed support as a result of the COVID pandemic, yes, SME was actually leading on that. And we found the businesses coming out and saying, give us a moratorium, give us a payment holiday, let's support us in terms of the recovery efforts, even in certain instances giving additional, especially from our working capital, giving additional facilities. We did lots of training webinar to make sure that we are holding our customers on our hand. We don't abandon them during the times of difficulties. And to be honest, right now, we did a payment holiday last year of about 62 billion shillings of our book. That's close to 30% of our total lending. Yes. At the moment, when we look at that, 94% of that 62 billion has already recovered. These are customers who have come, payment holiday has come to an end, and they're saying, we are now in a good position, we can release, the payments. It's the same sector today who are remembering that we supported them last year, and they're now coming to us to make sure that oil and they continue working with us. So SME, to be honest, it's one area that we love. We have a huge appetite for, and we are holding these customers to make sure that we can be able to support them together with their businesses.
Pretty much, which therefore makes me talk about some of the products that you've actually launched to help you sort of push your lending in this specific sector. Key focus on the SHE account. Is it possible for us to get an evaluation on exactly how this specific product is performing or has performed in the first 6 months of this year?
Yeah, that's a very good question. I think we launched the SHE account, Women in Business accounts, targeting the women who are doing businesses. And in there, one of the key areas that we launched was unsecured lending. Knowing the challenges that women in this country have had in the past without tangible security, that has really picked up. We've seen a significant growth uptake in the product. And tied with that, we've got things to do with LPO financing, invoicing, discounting, which I must say that has been increased a lot with the women.
Yes. All right, let's go back and look at exactly how your lending was structured and what you will still continue to say quite a hot and cold environment despite the growth they're talking about this year. In the first 6 months, we did say that wholesale banking did contribute a lot to that income that you got in the first 6 months of this year. Well, retail banking also grew, but what was important to note is that wholesale banking did actually eclipse retail banking in terms of that revenue. For somebody looking at it from that perspective, could you say that you'll continue to focus on wholesale banking, or you're still waiting for the macroeconomic fundamentals in the country to change as well we see retail banking overtaking wholesale banking?
To me, both very important for us. And yes, we've seen this because it's cyclical. If they are 1 year, one of be it retail or the wholesale is doing extremely well, the other one not at that level, and then come the following year, the cyclical effect picks up, and you find the other one picking up. I think the key word here is to make sure that it's a well diversified book, where you're not putting a heavy reliance on just one side of it. When I look at wholesale and why they've contributed to a bigger profitability in these financials. It's because these same customers have been able to embrace, technology.
Yes.
So you find the cost to serve these customers has come down. They have the comfort of their home, be it internet banking, all these alternate channels that we're talking to. They're actually now embracing this, which means we are not getting that big, traffic coming to our branches. That's one. The second one also is the fact that the impairment levels is what we call the price for risk. Loan loss ratios for this group wholesale banking is actually significantly lower than on the retail side. These are businesses, as mentioned, we give them payment holidays. Their businesses are quite solid, and as a result of that, we're not having huge exposure.
Pretty much. All right, let's talk about another area that stood out and this results. I mean, non-interest income grew, but then you said one thing, despite the effects of COVID-19, reduced margins as well. Yes, I would like you to comment on that. But again, as you comment on that, could you like to tell us this morning the impact on the removal of a mobile transfer charges? Would you say that they've also impacted to a greater extent the non-interest income that you've recorded in the first 6 months of this, Mr. Yusuf?
Yeah, absolutely. I think, and again, this is, together as banks, together with our regulator, we have to come to the point. The government had, for example, last year reducing corporation tax rate.
Yes.
From 30 to 20. The bank's response was, to the wallet, to just make sure that then most of our customers then seen, the digital solutions that we had introduced.
Yes.
So yeah, it has a dent on our financials, but then looking at it in a bigger scale in terms of supporting our customers during this pandemic, it was the right thing for us to do. So
yes.
That's in terms of the non-interest income. Your question on reduce the margin. This was more on the income, net interest income.
Yes.
We've been pricing our customers, a big portfolio of our book is actually linked to the old CBR during the time we had interest rate control.
Yes.
And as being as responsible lenders, that same portfolio has been ring-fenced. And whatever happens with the CBR, the central bank reference rate, if it's coming down, we pass the entire of that benefit to our customers.
Yes.
Which is something that we've done. CBR, comparing the two periods, has actually come down by nearly 100 basis points, and the benefit is right in with our customers. But equally, we've forced whichever the drop in our cost of funds. The margin, but that one is balanced because of the PR and then as managing our cost of funds.
Pretty much. All right, another interesting area is exactly even how your gross loans, when you look at it from quarter one, from the first 6 months, of 2020 to the first 6 months of 2021, is that your gross loans to the economy have really grown. When you look at that, especially when we were optimistically approaching 2021, is that you saying maybe things are going to get better, or yes, they're getting better?
I think it's a blend of two. Absolutely, things are getting better. If you look at even GDP, last year all of it was contracting. Now it's picking up. So that's for sure. The economy is recovering, not maybe at the pace we would have expected. Of course, because COVID is still with us. So that's one of the sentiments. But then also remember, and this is I'm not talking about just the country, but also the world as a whole.
Yes.
COVID is here. Vaccinations are coming through, but then people are saying we have to operate. We have to survive. Businesses have to be open. We have to learn how to live with COVID, and all of these learnings are coming. You're finding things to do with supply chain, get you some. All of that is so it's twofold. Economy is picking up, but also people are now getting to know how to work and progress during this COVID.
Let's talk about another interesting area as well in your overall results for the first 6 months of 2021. Interesting to note that mortgages were part of your area that was not affected so much. And the first 6 months of 2021, despite a lot of job losses within the economy and a lot of corporates cutting back on salaries to their employees. Could you comment on that? What specific area really ticked and your mortgage lending?
Yeah, I think mortgage is one area you've seen is among one of the big four agenda for the government in form of affordable housing.
Yes.
And we're able to embrace that. And then don't forget that this is a product that is actually secured. I know we do a big chunk also in terms of unsecured lending, but this is actually secured. And if the fundamentals are working, even during the time of COVID, and you're able to support your customers with payment holidays, etc., this pandemic will come, it will be managed, and things will have to move on.
Yes.
So we gave our payment holidays to our customers, including the ones who had taken mortgages. But I know they're opening up. Someone could have lost a job, they've gotten, maybe started a business or gotten another, a placement elsewhere, and they have to come back. The payment holiday, that holding our customers during the difficult time is what is informing this. But also remember that mortgage is secured as well.
Pretty much. Now, let's address what majority of people will consider the elephant in the room. We've seen other lenders in the first 6 months of 2021 saying that maybe this year is the year that we're going to get back to that dividend payout. We've seen exactly what Absa Group did last year as well. But then you said you are cautiously, optimistically waiting to see what the major indicators are going to be before you pronounce whether there's going to be a dividend payout or not this year. Can we address that, Mr. Murray?
Yeah, thank you. I know it's elephant in the room, and we've seen how the industry has been able to respond to this.
Yes.
I think the way I would look at it is, number one is to say our capital and liquidity ratios are at a good level.
Yes.
Because of the pandemic, whenever you have a pandemic, the first thing you do is capital preservation, and that informs why we did not declare dividend in 2020. The ratio at a very good level today, which supports us to be able to pay future dividend.
Yes.
But also at the same time be able to continue writing, loans and advances for our customer. So what I would say is we are in a good position at the moment. We are still under COVID environment, and vaccination levels are different. But if we continue with trajectory for full year, definitely be able to pay dividend.
Is it going to be hard to explain as to how 800+% growth in income is not going to be a good indicator for dividend payout?
It is this percent growth in headline.
Yes.
So started our way there at the moment. Capital ratios are in a good position. Then definitely we are going to be able to declare some good dividend.
Thank you very much, Mr. Yusufu Murray, the Chief Financial Officer, Absa Group, for taking time to speak to us about your first 6 months of 2021 results.
Thank you, and glad to be here.
Glad to have hosted you. Fantastic. Taking back to the time that he came into the studio this morning to speak about those results at Metropole TV KE across all your social media platforms. We take a short break.